It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money show. How's everyone doing? Hey, this is very exciting. It's the first time Mark and I are live in a couple of weeks after some vacation time. When I say live, I mean you guys haven't missed a show, but we have missed one another desperately. Mark has gotten a nice break from me, right? And we are here to continue answering your financial questions. Mark says, even during our break, don't worry, Jill, there was plenty of action. So what did I do on my break? I am in the middle of a 275-mile bike ride. I mean, it's a virtual bike ride to raise money for a cause. It's very near and dear to me. Mark, all I can tell you is that all those miles early on, I mean, I crushed my back. And so I need to spread it out. I tried to get like a little bit like, oh, while I'm out and I can ride my bike outside rather than inside, I'll get a jump on things. Oh, I'm in pain. But let's see. As of this day, first of all, I've crushed my goal. So that's number one, my fundraising goal. But more importantly, I feel pretty good. Like in terms of my mileage, I have I'm now have fewer than 200 miles to go. So I've done 87 of my 275 miles. That's not so bad. And I have till the end of September. I think I can do that, right? I'm hopeful. I can't try to do too much at once. That's what I've learned with my old back. So, and there will not be any lifting in between. So I'll be flabby, but I'll have lots of endurance. Okay. If you have a question, we would love to hear from you. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. And we are I would be remiss if I did not tell you that we are sponsored by Facet Wealth. Facet Wealth is a financial planning investment advisory firm that does really interesting things in the way they approach their business. They do not have a wealth or an account minimum, and they are focused on goal-based financial planning. And that planning comes from a dedicated advisor, and that advisor is a certified financial planner or fiduciary. So flat fee, conflict-free planning, try to expand the pool of people who they can serve. So I think that's a great idea. If you want to check out Facet Wealth, you should go to their website. It's facetwealth.com. Okay. I'm going to get in shape. You know, it's sort of like this is my warm up, and my warm up is with a tried and true question, Roth. Okay. So Lily writes, I love your show. I look forward to the program every day because Lily listens to my podcast, which you should also subscribe to, gang. So it's called Jill on Money. After listening to several episodes about Roths, I'm beginning to feel like we may be missing out on a great savings tool for retirement. Okay, here is Lily's situation. Her husband is 52, she's 51. She's a stay-at-home mom. Her kids are 16 and 19. My husband is in between jobs, but his last income was around $650,000. How about that, Mark? Here are their finances. They've got a house, $1.8 million house, a mortgage of $220,000 at 2.875%. My goodness. Okay. They have a vacation home. It's $1 million value, no mortgage. That's going to be their retirement home. They've got non-taxable accounts at Vanguard. She doesn't mean non-taxable, tax deferred, I think. That's what we're going to call those. So we're going to call those tax deferred accounts at Vanguard because they're from rollovers from old 401ks. That's 1.1 million. Then there's a taxable account of $1 million. And by the way, you heard that caveat, gang, non-taxable. I make that because it's not that it's non-taxable. It's just the tax hasn't been paid yet. They've got cash of $350,000. They've got college savings for both kids. They've got term life insurance, whole life, Oh, God. With long-term care, because of the Washington state requirement, estate documents completed, no other debt. They plan on selling their home at retirement that will add to their savings. Okay. So Lily manages and invests all the money. She says, I'm fairly conservative. I stick with mutual funds. I think we are a little bit high in stock allocation, maybe 80-20. I've been interested in the Roth. It seems so complicated. Okay. So since my husband is switching jobs, I thought this might be our opportunity to get into a Roth. I have several questions of how we can do this. If we transfer our rollover IRA into my husband's new 401k, can we start a backdoor Roth since we won't have any other IRAs to worry about huge tax consequences? Yes, you can. Second question. If my husband's new job offers a Roth, should we do that and leave the rollover IRA at Vanguard and not worry about the backdoor Roth? I would do both also, but I'm not sure that. But I just want to be clear one piece of this, which is we don't know how much he's making in his new job. So I presume it's about the same. So you're in a high tax bracket. Let's just go there. If the company has an option for a 401k and a Roth, should we transfer the rollover IRA to the 401k, start the Roth, and still do a backdoor Roth? Are we allowed to have both a Roth 401k and do a backdoor Roth? Yes, you are. Okay. So, Mark, what do you think? What's your goal with these folks? Because remember, just let's look at what they have. They didn't tell us how much they spend, but they've got the house, which is they're going to sell one house, right? So what they're going to have in their taxable account is going to be basically like 2.6 million, because they're going to have the house will be sold and it goes into the taxable account, right? I'm just taking out fees, et cetera. So then they have these non-taxable accounts. You want to do the rollover or not? Okay, I want to roll into the current 401, into the new 401k also. So you're going to have 1.1 million in your traditional 401k when you get to the new place. You can then start doing backdoor Roths if you want to. Then you can also do a Roth 401k. Do you want to do it even though he's in the top tax bracket, Mark? Yeah, I think yes also. Like, why not make a little Roth money here? Because I think you're going to probably, get some money into the Roth environment and you have plenty of money already in the tax deferred environment and go from there. Now, the only caveat I have is if he has a crapo 401k, then I might not do it. So if you wouldn't mind, just follow up with us, Lily. We think you can transfer your rollover IRA into the traditional 401k. That's easy. But if that new 401k is in some horrible insurance company plan of some sort, then don't do it. Then we got to talk more. You agree with that, Mark? Mark says it has to be very bad not to do it. Okay. So, Lily, thank you for starting off. That's a great first post vacation message and question. So, thank you so much for writing. And all right, gang, you got your questions. It can be Roth, it can be education. We've got a lot of stuff going on right now. Give us a holler. Ask Jill at jillonmoney.com. And if you don't mind, let us know if you'd like to come on the air with us. You can join us in the Sleep Number virtual studios. Wouldn't that be so cool? It would be very easy to do. So just do that. Just say, hey, I want to come on the air. Mark will do the rest. So jillonmoney.com, that's the website. Ask Jill at jillonmoney.com is our email address. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. And it's exciting for me to be back because we had put a couple of shows in the can during my vacation. Mark and I both took vacation. This is what happens when you work so closely with somebody. You basically have to we have to get synced up and have the exact same vacation times. Mark, did you read anything interesting over vacation or did you binge anything over vacation? Done. Easy peasy. That was one hurricane. That was like one hurricane back in New York City. That was easy. Yeah, I'm not that into that. I'm not that into it. I wasn't into the first season. I lost interest. I like reading it more than hearing it and watching it. I read a fantastic book called The Actress, and I was reading a lot. I had about 6 New Yorkers that were had piled up, and it was amazing. It was so great to be able to do this. But anyway, this book, it's called The Actress. It's a novel. It's by Anne Enright. That's my big summer push for everyone. Definitely read that book. Okay, let's get to your questions. Today, we start our listener calls with Marcy from Pennsylvania. Hi, Marcy. What can we do for you?
Good morning, Jill and Mark. I'm so excited to be speaking to you guys today.
So, what brings you to our airwaves today?
Well, I'm kind of somewhat at a pivot point, I would say, in my career. I've spent about almost the last 35 years working very hard, saving a ton, maybe not thinking so much about then what. And now as I'm looking ahead, sort of thinking about semi-retiring. Of course, COVID's impacted that a bit. Now I feel like there's a number of decisions that we need to make over the next couple of years, and I would love your input on some of those decisions.
Okay, so there's so there's a partner. So you are married, and how old are you guys?
I am 63 and my husband is 69.
And are you both in semi-retirement or contemplating that? Where do each of you stand in terms of career?
So I have my own consulting firm, and I was, starting to cut back, and then COVID came. So I said, well, I can't travel or do anything. So I really kept working through COVID, although not taking on as many assignments as I had pre-COVID. So I am probably working 50% of what I used to work. My husband's cut back quite a bit, but still he's in the arts. He has something is more of a hobby, passionate type of career. So he's not making a ton of money at this point, but still loves what he does. So, it's more about keeping ourselves busy and all of that. But certainly, as we can start to travel again next year, I know I could retire now, but I'm just trying to think about kind of what to do because there's some moving parts, I guess.
So if you look at 2021, tell me what your combined income looks like right now.
2021, probably around 75,000, I would estimate.
Do you think that if you were looking forward, you're 63, but if you look a couple of years, like, is this about what you think you'll be making until you're claiming your own Social Security? Or I don't know if your husband's claimed his or not, but is this kind of the income you're targeting right now?
Actually, I would like to work less. Maybe over the next 2 years or so, my actual working income could go down even further than that, maybe even closer to 30 to 50. And let's start to supplement it with, our savings.
We'll get to that in a second because you said you saved a ton, and I happen to know a ton may be an understatement because I read your email. So let's talk about a couple of things. So first of all, your husband has already claimed Social Security, or is he delayed?
He claimed at full age. So yes, he is taking Social Security. He's on Medicare. His Social Security is about $680 a month after his Medicare premiums.
Okay, got it. All right, now let's go through the savings. Let's start. You've got an emergency reserve fund?
Yes, I have emergency reserve, 110,000 or so.
And is that like in cash, or is that in investments, or is that, is it really just really boring stuff?
A lot of it is still invested. I mean, I'm mostly in like index funds, but some of that is in cash.
All right. So then tell me more about your tons and tons of saving.
We were late to the Roth, IRAs just because of our age, but we did start when those started. So between the two of us, we have about 230,000 in Roth IRAs.
Okay, great. Now, traditional IRAs.
So my husband at different points has had access to IRAs. So he has about 170,000 in traditional IRA.
And for you, have you been putting money away in your own retirement plan? Like, how have you been managing that since you're self-employed?
Okay, so I started my career, I worked close to 25 years in corporate America, literally from day one, started stashing every penny I could in what was for a long time traditional IRAs. traditional 401ks at work. And then when I started my consulting business about 15 years ago, a planner, CFP recommended I open up a personal defined benefit plan, which I had never heard of. And it was probably the best thing I ever did. So throughout my last I had that plan open for 10 years when I was really making some good money consulting and put away probably 50% of my income every year almost. So we never really changed our lifestyle, even though my income started, going up when I had my own firm.
And the defined benefit plan, you said, did you close it down and roll that over?
I did. I closed it down after 10 years and rolled it to traditional IRA.
So how much in all of that pre-tax retirement savings do you have right now?
Well, because the markets have also been on fire, I now have about $5.5 million.
Mark, what kind of sounder could we have to warn people that they are going to hear from somebody who has saved a ton of money and they're going to complain to me? What is the sounder that is like should we have like a bomb? Should we I celebrate this. I think this is amazing. I just want to know, Marcy, when you say you were making more money, like how much more money were you making in those years?
When I left corporate America, my income was, somewhere between, let's say, 150 and 175, depending on bonuses.
Okay.
In my kind of go-go years as a consultant, there were probably 5 or 6 years where it was north of 250. Maybe.
But you know what? You weren't making $2 million. You weren't working for a big Wall Street bank. You made money and you saved a ton of money. Correct? Yeah. Is that the fair way to put it?
Correct. And I've been driving a 17-year-old car. So if you saw me on the street, you would say, oh, yeah, there's a nice working woman, but
So this is fantastic. I mean, truly amazing. So congratulations on being an amazing saver. Really, it's fantastic. Now, let me ask you a couple of other questions while I have you here. So let's talk about income, because at age 70, what do you got? Let's just say like both of your Social Security amounts will be about how much when you reach 70?
Okay. I checked into that, about $4,500 combined a month.
Fabulous. Great. Is there any other income? Do you have rental property or any other income distribution vehicles that are out there?
We have one investment property that we get like $1,400 a month. I mean, there's no mortgage. Mm-hmm. I'd like to sell that at some point. We're just sort of waiting for the tenants to move. We like them, so we don't want to kick them out. But
okay.
So more, maybe $500 a month if that were still going on, I would net.
About how much do you think your monthly need is?
Well, I've always kind of said about, $125 a year is sort of what we spend. Let me see. So, $10,000 a month maybe.
Okay.
Pre-tax.
And
that's getting large, for us.
Okay. I know you don't know how to spend money, you and your 17-year-old car. Obviously, you have plenty of money to retire, right? Because you've got $6,000 a month, which will be Social Security and rental income. And even if the rental income went away, you have $6 million. So you're in great shape. Okay, we're going to get back to Marcy's question in just a second during the break. Why don't you go to Amazon or wherever you buy books and go get The Actress. And then while you're there, you can buy my book, The Dumb Things Smart People Do With Their Money. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
Okay, let's get going here. It's Jill on Money. We are continuing our conversation with Marcy from Pennsylvania. For you, tell me what the real questions. I know that this is going to be about how we're going to reduce the amount of money that's taxable to you. Is that correct?
Yeah, that's part of it. And again, I know I don't have an issue, but I'm just trying to optimize at this point. So I haven't really thought about the future that much. So a couple things. One is, we have a mortgage right now. Do I pay it off or not pay it off? The house is worth about $1.1 million. The mortgage right now is about $380, $390 left on it. you're going to cringe, but it's a 7-1 ARM because when we moved to, where we are now, like 9-10 years ago, we had sold our old house. We were planning to pay cash for this house, and rates were so low. I said, let me do the ARM. I'll pay it off next year. And then I wound up investing it, which turned out to be good. But at this point, it's going to go up again. It's going to go up at the end of the year I'm sure with rates going up. It's still under 3%, which is great. But anyway, I kind of like to get rid of that if I could. And then the other thing is I've already done some, I've used some of the online calculators. My RMDs, if from what I have today, they're estimating will be like 325, 345 in that range.
Ugh.
Way more than I need and way more than I've ever had. It puts me in obviously a higher tax bracket. So my question is, should I start taking out maybe more substantial amounts from the IRAs between now and 72 when those kick in?
Yes, no doubt. So what I'm thinking is this. Right now, you guys are, I don't know, you're probably hovering in the 12 or the 22% tax bracket, depending on the year. But I really would not worry about keeping it in the 12%. You just don't have enough time to get the money out. So what I would do is before you get to your age 70, not 72, because I know the RMDs start at 72, but so too does your Social Security, which is going to add to your burden. Maximally, you would want to keep your income under about $330,000 between the two of you. And you can back into how much money that is and pay the 24% rate because you know what that is. That number is only going to potentially be higher as you retire. Now, the thing that's also kind of interesting, I don't know, like the mortgage payoff, it's fine. You just don't have a ton of money in taxable assets. So the brokerage account, you're going to have to soak up some of the money there. So maybe the first thing we do is, maybe number one, let's get 170 grand of your husband's traditional IRA, take it out. Let's be done with it. You're going to pay the tax. It doesn't matter whether it's a Roth or not. You're going to need cash because you need cash to kind of finance the next few years, your 7 years. And so you can live on that. So let's take the money out of his account, stop working so much so you don't pop us into a higher tax bracket. And then next year you start working on your own account. The thing about the house is I don't want to pull the money out of that account and pay down the house. I just feel a little bit like I don't want to soak up that liquidity. In other words, I don't want to pull the money out to pay the tax and then soak up that liquidity. Are you going to sell this house? I didn't ask you that. I'm sorry.
5 years, maybe.
In 5 years? Okay. So you could do another ARM then. You are going to put a trigger to yourselves if you do an ARM because then you really better sell it because rates are going up. So I would probably refinance that sooner rather than later and get it done and just fix it or just get another ARM or get a 10-year ARM instead of a 7-year ARM, but whatever, you'll be fine. And you'll pay that off eventually. You really will. It's not going to be a big deal, right? If for some reason you said that the investment property, how much is that worth?
Oh, like 220.
So if you're going to eventually sell that, that'll help you with your liquidity issue. Meaning when I say liquidity, you have plenty of liquidity. It's just that it's not been taxed yet. So if you have that property and then you eventually sell your house, then you're going to really be able to get a lot of this money out of your IRA next and start whittling that down and paying the taxes at the maximal 24% tax bracket. Don't go above that though. And then I think it's really about managing this process so that you enjoy yourselves. You've spent a good chunk of your career being super savers and you should enjoy yourself. I don't really think there's anything, bad about this. Do you have all of your estate planning done? Where do you have kids? I didn't even ask you about that.
Yeah, we have a daughter, we have a grandchild, which is the best thing ever. So she's married, she's all settled, which is great. All of our estate documents are done, wills, power of attorney, all that good stuff. So that's totally check the box. The one other thing you didn't specifically mention, but since you didn't mention it, I'm thinking it's a no. Everybody says we should be doing Roth conversions, but I kind of look at that like I'm not sure that makes sense. And I don't really, like, as you said, the reason we don't have a lot of after-tax money, by the way, is we wound up buying a condo last year in our daughter's town in her city so that we could visit baby. So the money that I was quote unquote going to use to pay off, it's a much less expensive condo than our house. So the money I was going to use to pay off my current mortgage, we wound up buying cash for a condo so we could be near the grandbaby.
Okay. All right. Well, so like right now, I don't see a huge reason to convert to a Roth. I mean, you could potentially, it's kind of like we want to see how things go. I just want you to have more liquidity. At the end of the day, it's sort of, you get to the same thing that, your daughter's going to inherit a ton of money. There's no way you're spending all this down. What's her tax bracket right now, by the way?
Their combined income is probably about 175, something like that.
Yeah. So she's probably going to be in a lower tax bracket than you. So if she inherits her IRA, that's fine. I mean, let's see. I might change my opinion if you had more liquidity. If you have that. Okay. So you sell the house. Let's say you sell the house. You've got that money. You sell the renter property. You have that money. Now there's like a million-ish that's in cash. Now, maybe it's a couple of years from now, and you could potentially start converting some of the money into a Roth. But I just need to make sure that you have that cushion to A, pay the taxes, and B, be able to spend the money you need. So you could potentially start converting the Roth because the asset received as a Roth for your daughter is far better, obviously, if you pay the tax than she. And, it's kind of a bet on where tax brackets go. And I'm not so convinced that for her it's going to go way higher, but we'll see, right? And stop working so hard, Marcy, for God's sakes. I mean, I never say that, but really it's been an amazing ride for you, and you have done a phenomenal job of saving. So I really think you're in great shape. Okay, if you, like Marcy, want to come on the program, just give us a shout. Ask Jill at jillonmoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money, and we are attempting to take the mystery out of your financial life. And one of the ways that we do that is we encourage you to send us your personal financial questions, but also you can send us questions about what's going on in the economy, even though it can seem mysterious at times or maybe confusing. Maybe we could help you understand that. Mark, by the way, while we were on break, a really crapo jobs report. That was a bad one. And I was working that day, and I felt a little bit deflated about it. Do you think that this is the beginning of something really worrisome, that only a couple 100,000 jobs, not the million from the previous 2 weeks? Or do you feel like it's a 1 month or just a couple month breather during this variant exposure? Well, Mark thinks that with unemployment benefits expiring, there's going to be a lot more people into the workforce. I'll tell you what, I don't think it's the unemployment benefits. I think it's school starting is a much bigger deal. I mean, I do think that the unemployment benefits help, but it's not that much money. To me, the big thing that I'm hearing about from listeners and from viewers is all about, I got to get my kids' schedule set because it was so crazy for the last 18 months. And so I'm hopeful that things are going to settle back down. We're averaging about, I don't know, just under 600,000 jobs a month this year. That's pretty awesome. And it's certainly a great improvement from where we were. But if you're having a hard time understanding about what's going on in the economy, send us your question and we'll break it down for you, because that's part of what we do. But of course, we do love to get your questions. And I'm going to do an email from Ted right now, who's found our sister broadcast. We have 2 podcasts, not one, but 2. One is called Jill on Money, and the other is called Eye on Money. You should subscribe to both. We have it right on the front door of our website at jillonmoney.com. You can check them out, subscribe to them. You won't miss a single episode. It's very easy. So Ted says he just found the podcast. Wait, let me see what date this is. He just found the podcast in August, Mark. That's amazing. We're expanding our listenership. It's great. Okay. He says, I've enjoyed listening to previous episodes. I've learned a lot. I'm hoping you can provide some advice on our particular situation. Okay. So Ted's 44. His wife is 43. They make about $245,000 per year. Ted maxes out his company 401k and he gets a 5% match. And then he says, we just started maxing out my wife's 457 and 403B plans. In addition, my wife will have a pension when she retires. She must be a teacher. That's such a great deal. We have approximately $670,000 in tax-deferred accounts. Pretty good. 240 grand in Roths, 90,000 in cash for emergencies. Okay, our plans recently started offering Roth versions of traditional 401k and 403b accounts. Up to this point, we had been focused on maxing out our tax-deferred accounts for retirement to reduce our tax burden. We do live in a high-tax state, California, so reducing our obligation has been a priority. However, I am wondering if we should instead opt to put a portion of the savings into Roth versions of the accounts. That way we would pay the taxes now and enjoy the tax-free benefits in the future. So he says, we are starting to lose access to Roth IRAs due to their compensation limits. I hate the thought of losing the Roth option completely. Outside of our retirement accounts, we plan to save 50 grand more per year. Holy smokes, all of which goes into the brokerage account. Between retirement and brokerage account, we save, listen to this, Mark, $117,000 a year. Oh my God. Okay, so here's the question. What portion of the retirement account should go into the Roth? I know this is really tough. I know when you live in California or New York or any high tax state, that's tough. So I'm going to just, he says they're not going to probably retire at 55. They're going to have the option to do so, maybe shift to lower stress jobs. He says we will need a mix of tax-deferred Roth and brokerage accounts until Social Security and my wife's pension kicks in. I'm just not certain what mixed. Then he said, writes, by the way, I laughed out loud when I heard about your trip to Las Vegas. We cannot stand Vegas. We avoid it at all costs. The 2 times we have been there in the last 20 years, we have left swearing we would never return. Some of us just weren't meant to enjoy Vegas like others do. Thanks in advance for your consideration. Mark, Ted and his wife are in the 24% tax bracket right now. I am inclined to make them into complete Roth shifting listeners. What do you think? I know you're in. He's all in. I think you should both do it. And I think I get that you want to reduce your tax liability because California is expensive. But you already told us you've got 670 already in tax deferred accounts. Wouldn't it be great if half of their money was tax deferred and the other half was in Roth? I think you can do that, especially given your ages. So I'll tell you what, I would max out both of these in your Roth options. You're going to pay more in taxes. That sucks, but you guys do have cash. And so I would do it. I would lock in 24% right now. And I wouldn't worry about it. You're going to have a pension. You're going to have money that's saved. You're going to have money that will have to be taxed later when you retire. So I think you're going to be all Roth all the time. And that's it. And you know what you will do in making this change? You will essentially now become the house, right? So you know why you hate Vegas and why I hate Vegas is because I'm not the house. I don't like having odds against me. We're going to play the odds, and now you're going to be the house, Ted. You're going to be the one who says, oh, wait, I have the odds are in my favor. And the odds are that your 24% tax bracket will remain 24%. I think it will. And I think you're going to have plenty of money, and you're going to have the ability to retire when you want, but you're going to have a higher tax than you'd like. So let's get some of that money into Roth just in case. Okay, you're listening to Jill on Money. If you've got a financial question, ask Jill at jillonmoney.com. We'll be right back. You're back. It's Jill on Money, and we are here answering your financial questions. Oh, wait until you hear the guest next hour. She is amazing. She is an economist, and we are going to explain the ways that college can pay off. So you're going to stay tuned. Second hour is coming up. Before we do that, let's go to a question from Scott about long-term care insurance. He says, my 78-year-old mother just received a notice that her CalPERS-based long-term care insurance is going up. Oh, my God. That was very New Yorky. Oh my God. Is going up by 52% to keep her 3-year plan at $166 a day. If she wants to maintain the current premium, her coverage drops to 2 years, $150 a day. She has a CalPERS pension plus Social Security, but the increase in premium will mean taking some out of retirement, which she doesn't want to do. She's got 500 grand in Vanguard funds and bonds, as well as her house worth 500 grand. It's paid for. She's in good health. She does have rheumatoid arthritis. I hate to see these rates go up, but she has been paying in for 35 years. I feel it's important to maintain her coverage. The letter advised that we can expect another 25% increase in 2022. You know what I would do? I would just go to 2 years at $150 a day for the current premium. That's what I would do. And I wouldn't do much more than that. And let's see how it goes. This sucks. It really does suck. But there's nothing you can do about it. Long-term care insurance is very odd, and insurance in general is odd. The way it works is they can't just raise the premiums on you particularly, but they can raise on an entire class of people, and they have to petition the state to do so. What's weird, though, is that, this is part of the California pension system. And so it seems to me it kind of stinks that the state didn't figure out a better way to kind of hold the line on this. It's just that they have all mispriced insurance. I feel like the 2 years, it's some coverage. It's better than nothing. Yeah, I know it's hard if you've paid into this thing for so long. On the other hand, thank goodness she hasn't needed it. So there's that. So, okay, you are listening to Jill on Money. And if you would like to join us right here in the Sleep Number virtual studios, all you have to do is send us an email. It's askjill@jillonmoney.com. We'll be right back. Stay tuned. Beth Akers, college education. She's next.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It is hour number 2 of the Jill on Money show, and we are so happy to present a great interview that we were able to conduct here in the Sleep Number virtual studios. It is with Beth Akers. The name of the book that she has written, she had co-written another book, but this book is so great. It's called Making College Pay. An Economist Explains How to Make a Smart Bet on Higher Education. Now, what we're about to hear is a deep dive into the economics behind the decisions that people are making for college. Here is the beginning of our interview with Beth Akers. Now, you are a numbers geek, let's be honest, right?
Yes, I'll take that.
Okay. And you wrote a book, you co-wrote a book rather, called Game of Loans, The Rhetoric and Reality of Student Debt. So just give us a little bit. I didn't read that one, so I did read your current one. Tell us a little bit about that book and what you were trying to accomplish with that and how it led to this book.
Sure. So that book sort of came out of my irritation with the way that we generally talk about college and especially student debt. So there's a sense that people who borrow are necessarily worse off than if they didn't, and every dollar that they borrow makes them worse off. Now, economists have been showing evidence for decades that college offers a huge economic return. So the idea that borrowing to make that investment necessarily puts you in a bad place just doesn't jive with that. So that book was really an attempt to get people to understand this way of thinking of college as an investment, and borrowing to make that investment is not necessarily such a bad idea. Of course, sometimes it doesn't work out well, but that's not the typical story.
So how is that book received by the college funding and the college screed group out there that says never, ever, ever, ever borrow?
Well, I'll tell you what, I got a lot of speaking invitations after that book came out from college and university associations who are kind of thrilled to have permission to keep charging prices and asking students to borrow. But from the more student advocate side of the community, people were not thrilled with this. I mean, I became known as the bit of a student loan crisis denier, which is not entirely accurate, but I guess there's some truth in that. I mean, I like to characterize that the problems that we face are different from the macro, the sky is falling kind of narrative that we have been hearing about student debt.
I think it's great. I love counterintuitive stuff. I had always read all these studies that show that when you have a college degree, you make more over the course of your career. Can you give us the actual numbers? Like, what is the differential?
Yeah, that's exactly right. So, look, to be geeky for a moment, it's really hard to measure this, right? The people who go to college are kind of different than the people who don't. So, if we just look at the differences in what they earn, it doesn't quite give us exactly what it is that college does to your earnings. So, but economists have tried to estimate this in a number of different ways, and it always comes out that it's a huge positive number. So, one of the recent numbers from a Georgetown study says you earn upwards of $1 million over the course of your career with a bachelor's degree versus if you had just entered the workforce after high school. The New York Fed has a really great study that estimates it on a percentage basis. So they say, if the investment you make in your education were measured kind of like we measure the stock market, you'd have a 15% rate of return on associate's and bachelor's degrees. So while any of these studies has issues, right? I'm not going to hang my hat on any single number. I feel confident that based on this body of research, that it's just a large positive return.
I think what's interesting is that because you are data driven, that you're also a scientist, and so you want to make sure that we are framing these questions the right way.
Mm-hmm.
And the one thing that I thought was really interesting early in the book is that you talk about how, the fact is that you're paying for this college education, right? This is a steep price tag, but your annual earnings, the wage premium over what you would have earned otherwise, continues for your lifetime.
Mm-hmm.
But how does carrying the debt play into that?
So if you think that, the effective rate of return on a college degree is something like 15%, call it around that, right? That's what the Fed estimates. And then people who are borrowing from the federal loan program right now are borrowing at an interest rate of 2 or 3%. So the difference between those means that even if you're borrowing and paying interest along the way in order to get that wage bump, you're still coming out ahead. It's the old idea that, you pay down your highest interest credit cards first, right? Because borrowing at a low interest rate to invest in something that yields a high rate of return is actually a wealth enhancing activity. So that's what's going on here. Borrowing at a low rate, of course, it's less of a return than if you were able to pay cash, but who's got the cash to pay for college today? So it eats into those returns a bit, but the returns are so generous, at least on average, that borrowing to make that happen for yourself can really still be a very smart and savvy option.
Just to put this in stark terms, Beth Akers, the economist, author of Making College Pay, writes the following: it's almost always better to borrow as much as you can. That is going to blow the mind of people. It really is, okay? But
Yeah.
what you're saying is right. It is actually an arbitrage. So
Right.
the interest rate on federal direct Stafford loans right now for undergrads is 3.734% this year, okay?
Mm-hmm.
This academic year. Okay, you're going to borrow 3.734 and you're going to invest in yourself at a rate of return of 15%. That makes sense. What upends that calculation?
What upends that calculation is if you end up in a degree program or at a university that does not yield those returns. So when we talk about the $1 million, the 15%, that's on average, right? So not everybody is experiencing those outcomes. There are things you can do to ensure or make it more likely that you end up with a good return, but not everyone's going to get there. And so that's the problem. That's the social problem that we have to solve with student loans right now, which is that people are borrowing and sometimes not seeing that return. And those people can really be up a creek without a paddle. So that's what I really advise in the book, is to think carefully about not just the cost of education, but the risk. And is that risk something that your family or you as an individual are able to bear?
Now we're going to go into, everyone listening, calm down, because we're going to explain these terms. Because if you fell asleep in econ or if you fell asleep in finance classes, we are going to talk about risk, which I am very into. generally speaking, there is systemic risk and there is idiosyncratic risk. Let's
Right.
talk with systemic risk. Explain
Okay.
that to the listeners.
So, the biggest source of systemic risk here is that you start college and graduate during a pandemic. That might have seemed like a crazy idea if I'd
Yeah,
written this book
bad
5 years
idea.
ago, but now we all see that as a potential reality. So what happens is that when you graduate, when the economy is in an expansion, you get to ride the benefit of that. Start out with a great first job; it's a good paying job, and then the heightened wages that you get because of being graduating in expansion will actually last close to your entire career. It's sort of crazy. On the other hand, if you graduate during a recession, you might not get a great first job. Maybe you have to take something in the meantime until you get something in your major. And the effect of that actually lasts over your career as well. So the problem is that this has nothing to do with whether you've made the right decisions about where to go or what to study. This is just the risk that we all face collectively when we start college.
We'll get back to our interview with Beth Akers in just a minute. If you have a college funding question, if you have a question of retirement versus college or whatever, doesn't matter. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are in the middle of a conversation with a wonderful guest. Her name is Beth Akers. She is an economist. She's written a great book that is called Making College Pay, and who doesn't want to make college pay? And I was thinking about this book and wondering how our sponsor, Facet Wealth, would feel about this. Because, we've had one of the guys from Facet Wealth on the show before, Brent Weiss, and we've talked about education. He says it's one of the toughest questions that people will ask because they really want to know what's the right balance between saving for retirement, saving for college, and whether the investment that they make for their kids' education is worth it. Now, we're going to talk more with Beth Akers about how it can be worth it. But if you want to know how to manage that question, how you can actually make college pay for your kids, but also how not to rob yourself of your retirement, then you ought to check out our sponsor, Facet Wealth. They provide flat fee, conflict-free planning from dedicated certified financial planners. And it's not a call center situation. These folks are fiduciaries. They've got to put your needs first. So they're going to tell you what it is that you can do to help accomplish your goals. That's what it's all about. So go check out Facet Wealth. The website is facetwealth.com. Okay, and so let's now talk a little bit about some of the people that are most hurt by college decisions. They may be the unlucky millennials. They are the ones that have had bad timing. And we're going to talk more about that with Beth Akers. She's an economist, and the book is called Making College Pay. Here's more of our interview with Beth Akers. This is one of the things that we feel so bad about with certain millennials who seem to just keep getting whacked over the head like piñatas in terms of their unlucky timing versus, say, someone like me who was lucky to graduate in the 80s. And like every idiot who wanted a job and had a heartbeat got a job. And it was pretty lucky. And even if you had a short-lived recession here and there, it was pretty much a straight up arrow, right?
Yeah. Yep. This is a risk that's hard to get out from under. I mean, there are some new mechanisms that are emerging that I'm really excited about. There's startup companies that are coming into the market and they're saying, look, if you think of education as an investment, we know how to insure investments so that people are not putting it all on the line. So the idea of insurance, right? We're all familiar with how insurance works for our home, for a renter's policy, things like that. We're starting to see companies and colleges offering insurance policies to protect against the sort of systemic risk that we just talked about, of things like graduating during a recession. And also they protect against the idiosyncratic risk. That's risk that is just really more individual. They're all new, but I'm really excited and hoping that that market takes off.
Hold on a second. I want to understand, who are the actuaries who are trying to measure how to quantify systemic risk based on someone going to college and not knowing what they're going to end up doing?
So these are the financiers behind commercial lending. I mean, it's a tough business, but what we see is there's actually a lot of data on how students perform coming out of different majors, coming out of different institutions. Obviously, you can't predict outcomes as well if you don't know what a student is going to study, but that's the challenge that these companies are facing, is that how do you measure what are the likely outcomes? How do you price the risk that an individual faces? And do students want to pay that price to protect themselves from the downside? So it's an emerging market. I think it's super exciting. It's not accessible everywhere, but I'm really hopeful that we see more of it in the future.
All right. So we talk about systemic risk. We're all like, not we, but anyone who's got a kid going to school or anyone thinking about going to school, him or herself, you're in the pool automatically. You've got that risk. It's like, okay, you're an investor. You're going to have to be subject to fluctuations in the marketplace.
Right.
However, we then have idiosyncratic risk, meaning that the things that you are choosing to do or not do can put you at risk. And let's talk about that.
So the first one I want to talk about is the potential that you don't graduate. Everybody who starts college imagines they're going to finish, right? Because it's just not worth the money unless you walk across the stage of graduation and get that credential that you can show to employers. The reality is that a huge number of students are not graduating. And so those people have put out the money, they've borrowed, and they're not getting the value of the degree that gets them higher wages in the labor market. And just to be clear, if you get half of a bachelor's degree, you don't get half of that $1 million earnings bump over the course of your lifetime. That's just not how it works. You've got to cross the finish line to get there. So that's a huge source of risk that I think people really underestimate.
And you say that based on a lot of research that really most people are dropping out before graduation or not finishing up or taking way longer than they should is actually financial, right? I mean, that, there's something going on in the family we can't pay, or there's a health issue and we can't pay and you need to be home or you have to be working. And those are things that are pretty tough to control, right?
Yeah, exactly. I think we tend to think about the 18-year-old who has their parents' support and is, moving off to college for 4 years and can focus solely on that. That's not really the reality for most students. The majority of students starting college today are adults. They're working jobs. They have children. Maybe they support their parents. So the lives of people who are in college today are much more complicated than we often imagine. And when you realize that, it's actually not so surprising that things tend to get in the way of them being able to complete a degree on time or even at all.
You spend a lot of time when you're talking about idiosyncratic risk about choosing the wrong school. Now, Beth, I'm no economist. I'm just a former trader turned certified financial planner turned media host.
Yep.
And I wrote a book a couple of years ago. The book was called The Dumb Things Smart People Do with Their Money. And one of the dumb things I said was that you kind of paid up for a crappy school and that it puts the kid or the family at risk in a ridiculous way.
Right.
Of all the things I wrote about, that got so much pushback. I think also because the people who buy these kinds of books are the kinds of people who don't get financial aid, and they really feel like they should be able to give their kids whatever their kid wants, even if they're going to Wasamatta U and like that's a rotten fourth tier liberal arts school. Like they just can't say no to their kids.
Right.
So I want you to talk about how choosing the wrong school can be a big risk and how to mitigate that risk.
So Jill, like when you and I were deciding where to go to college, I don't know if you did the same thing as I did, but I went to the back of Barnes and Noble and sifted through that telephone book like index of colleges and the U.S. News and World Reports studies that describe the different campuses. And it said from surveys, did students think they had a good party life on campus and what majors they had? And that's how we picked colleges. I mean, there was a lot of, going with what the marketing told you that the institution was all about. Students today have a humongous advantage, which is that if they want to make an economically minded decision, which I think most people do, even though they don't necessarily come to the table with that as their first priority, there is data available to help you make decisions based on where you're going to get a return on your investment. In the past 10 years, we've had the development of a website called the collegescorecard.gov. And what that is a place where the federal government is publishing the earnings of individuals graduating from each accredited institution and major across the entire country. So if you're someone shopping for college and you're thinking, okay, this is a liberal arts college, it's kind of fancy, it must be a great place to send my kid, right? I'm going to get a rate of return that's going to be fantastic. Now you can go check. And I think, and what I'm afraid people are going to find often is that we have confused the idea of price and value. When there's not good information about what the service is worth, what that education is worth, people are going to say, well, it's very expensive, so it must be good, right? I think that's very natural. But the reality is that no, sometimes when it's expensive, it's just expensive. Part of what you're buying is a country club experience for your child for 4 years. And there's nothing wrong with that. If that's what you want to spend your money on, good on you and go for it. But for the 90% of people who go to college and state that their number one priority is to get an economic return, to get a better job, to advance themselves financially, this has got to be the starting point for where they think about where they want to enroll, where they want to spend their dollars, and where they want to spend their time to invest in their education.
We'll get back to our interview with Beth Akers in just a minute. If you're listening and you've got a question, hop onto our website, jillonmoney.com, click on the contact button, and you will find us. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Do you ever wonder which majors or areas of concentration pay off most for your college experience or for your kids' college experience? That's what we're focusing on next. It's more of our interview with Beth Akers here on the Jill on Money show. Let's talk about the area of concentration or major. And I love the idea, by the way, that you actually just say like worthless major, like basket weaving. Okay, I went to Brown University and there was something probably pretty close to basket weaving in the curriculum. So can you talk a little, I was not such, but why is the major important?
What we find, and this is from research from Professor Doug Weber at Temple University, is that in terms of the data, what you study actually matters a lot more than where you study. So we put so much emphasis on getting into the right college, right? We celebrate where people are going. It's like a big Instagram reveal thing for high school graduating seniors these days. And no one talks about their major. It turns out that that's much more consequential in terms of whether or not you're going to see a financial return than where you go to school. I think that's surprising to some people. And sometimes people misinterpret what I say and that they think, well, I don't want to be an electrical engineer. So you're not going to take your advice because you're just telling me to go after the highest earnings occupation I can find. That's absolutely not true. What I'm advising is that you know what you're getting into. If you've got the financial backstop to we use basket weaving, right? Because we don't want to offend anybody. I'm pretty sure there's no basket weaving majors actually at accredited institutions. But, if you've got the financial backstop and it works for your family to be a basket weaving major and then go out and see no economic return on what it is that you spent, good on you, go for it, right? But that's not the reality for most people. And I think going into these decisions with your eyes open is really all that I'm advocating for.
It's interesting, though, because I guess what I'm wondering is, so if what you studies matters more than where you study, does it stand to reason that Jill Schlesinger, graduate of Brown University, studies international relations? It's fine. Whatever she wants to do with it is fine. But that if I study international relations or some opaque political science-esque kind of history, blah, 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 at a college that's not seen as prestigiously as an Ivy League school, that
Yeah.
would actually be a big problem?
Yeah, years ago, being an investment banker was the big thing, right? Everybody wanted to figure out how to get on track to be an investment banker after they graduate. And people would often cite to me, well, we hire English majors from Harvard and Princeton and Yale to be investment bankers. I thought, well, that's great. But that informs like the very tiny percent of people who are at those elite institutions. Those folks are going to be just fine, whatever they study. That's the reality for them. But for the masses, people who are not at those top 10 institutions, what you study does matter. So I don't want to give the wrong impression. I mean, if you've gotten yourself into an Ivy League institution, you sort of already won the lottery, right? When it comes to this kind of thing. If you are seeking a return and you're not at one of the top elite institutions, choosing a major with that in mind is actually critically important.
We have just, I'm talking to you after we've had a couple of conversations with listeners. The amount of money outstanding in debt is pretty intense. So let me just look at my notes so I can give you the right numbers. The veterinarian who had $250,000 of graduate school debt. And I'm wondering, the graduate school loans are far more expensive and they seem to pile up like crazy. Now, this veterinarian who makes $140,000 a year has $250,000 in debt.
Mm-hmm.
And so she's in her 30s. Was that a wise or unwise decision in your mind?
Well, I mean, those degrees may pay off in the long run. I think that this is a case of what value does that individual place on being in that profession, and if it's worth it, if it's worth the financial sacrifice of not having the return that you could have gotten somewhere else, then that's just fine for that individual. I also want to point out, we hear a ton about people with these huge balances, and they're actually a small minority. That doesn't mean they're not important or we shouldn't worry about them, but they're a small minority, and they're also eligible for a program with their federal loans called income-driven repayment. It's a program that's evolved from non-existence in the past 10 years to the point where today, anybody who faces loan payments that are excessive relative to what they're earning can have their loan payments automatically reduced to an affordable level. And then if those loans remain unaffordable for a long period of time, 20 years for most borrowers, then they'll have those loans discharged. So it's important to realize that we do have that pretty robust safety net in place for these big borrowers. And in fact, that's part of the reason that I tell people it's almost always better to borrow, even if you've got the cash to pay for college, because this program has evolved to be something like an insurance policy for colleges.
And that's exactly what they're doing. It's funny you should mention that because she says she's doing income-based repayment and they're 10 years into it and they're making the minimum payments and it'll be forgiven 15 years later, right? And the loan is, by the way, it's a 7% loan. So it's not like chump change.
Right.
And the question was like, should we still pay it off? And the answer is no. Actually, you shouldn't pay it off because it's going to get wiped clean. And so it's really interesting how that calculation goes. And I guess the same with the public loan forgiveness program as well, right?
Right. And what we've seen is that a lot of students that are, have the most education understand this, right? And they're able to take advantage of the benefits of the program. We even have heard of law schools counseling students on how to get into this and taking it into account when they decide how much to borrow on the front end. What happens when you're in these programs and making the lowest payments possible, which you should be doing, is that you will have a growing balance, right? The loan is a negative amortization, meaning you're not paying the interest that's accumulating each month. It turns out that's a really scary thing for a lot of borrowers. The savvier ones, maybe like this individual we're just speaking about, see that and say, it doesn't matter because when I'm done with this payment period, it's all gone. It doesn't matter what the balance is. I don't have to pay taxes on it, nothing. But it seems like maybe some less informed borrowers are really put off by that. And I think putting themselves into more struggle to repay their loans than if that weren't the case. But it's one of those things that's, it's a hedge, right? Like, as you said earlier, but you gotta be comfortable with the idea.
Right. I think the hardest part is that just like that it hangs over you, and that's really what it is, that people are like, oh my God, I don't know if I can deal with that almost, right? Like, oh, it's that big number. If you have a financial question, college related or not, just send us an email, askjill@jillonmoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money, and we are the program that takes the mystery out of your financial life. You know, we've learned a lot, Mark and I have for sure, about the college loan experience through this program. I never had college loans. I was quite fortunate. Mark had affordable college loans that he paid off himself. And the whole world has turned around. And what we've also learned is that a lot of the government loans, and that's the majority of student loans that are out there, they have some really interesting features. And some of those features are not exactly, how shall we say, understandable to the mortals out there. You have to really dig deep. And then there's this idea, and we keep hearing from people out there like, well, wait a minute, I heard that there's going to be some overall loan forgiveness. So in this next part of our interview with Beth Akers, we're going to talk about loan forgiveness and whether or not that is a good thing. So here is the conclusion of our interview with economist Beth Akers. Let me ask you a question that you don't necessarily, I don't think you address this in the book, although I will admit to you that I was reading it at very wee hours of the morning. Tell me a little bit about your opinion around the loan forgiveness debate that's going on in DC.
Yeah. So this book I really tried to write for an audience of people who are trying to make this decision and stay away from my day job stuff, which is this political commentary. But the answer to this one is very clear. I absolutely hate these huge student loan forgiveness proposals that the far left has been floating for the past few years. So I will give credit to Senator Sanders and Senator Warren. They have succeeded in shifting the public debate about higher education so far to the left in the past 5 years that it's really incredible that people are talking about the idea of a student loan jubilee. I'll tell you the two reasons I don't like it. One is that a lot of very high income borrowers will be the biggest beneficiaries. If you think about who borrows a ton, people who go to graduate professional school, lawyers, doctors, these are high income people. They have large debts, but their income more than offsets how much they eventually will have to repay. So those are the biggest beneficiaries. The people who are in default most often with their student loans only have about $5,000 in debt. So we're paying these huge, huge, huge grants to people who don't need them in order to help out these people who we could really help out with a much smaller reward. The second reason is that we will be simply creating more of a problem for ourselves in the future. So, I'm already telling people, borrow as much as you can, right? Don't spend your cash on college. So if we were to pass a loan jubilee this year, wipe away everybody's debt, and I personally would be advising people to say, okay, when you think about how much you're willing to pay for college, you probably want to take into account the idea that there's some probability that you're going to have your debt wiped away again with the political pressure put on politicians to have another student loan jubilee. So, not everybody's going to act on that, but some will. And I think it will shade everybody's borrowing up a degree. Institutions will say, oh, great, I can charge a bit more. Or the increase in demand that it causes will allow that price increase to happen. And then we've just made the problem worse for ourselves. So
now you're not just a student loan denier. You're a killer of, but it's interesting.
I'm really popular at cocktail parties, I have to tell you.
I know, really. Really in the liberal hovels of the country. What's interesting though is there a case to be made for getting loan forgiveness for some of the more egregious or nefarious actors?
Oh, yeah.
Right. So that you're not saying. You're saying that just a broad-based wipe the slate clean, magic wand. No, that's not on Beth's to-do list. No, thank you.
Exactly. And I love that we have the income driven repayment system, because in our economy, we rely very heavily on education as a mechanism for social mobility, but it's a self-finance system, meaning you have to put your own dollars on the line to get through it. And so I think it is important that we have a safety net so that people don't have to risk life and limb in order to advance themselves economically, right? So I love that we have those programs. And I do want to help people out who invest in a degree not knowing that it's not going to yield an economic return to them, or people who, they went to law school, then they find they've got crippling migraines when they're trying to do the work and they need to do something else and it's not affordable to them anymore. I'm compassionate to all these cases where something just needs to happen to help out this person. In fact, I think we need to make a change to allow people to discharge their loans in bankruptcy, which is currently not allowed. So I'm all for, very specific instances, getting people off the hook when they really do need this help. But that broad-based forgiveness is just not the right way to go about it.
Would you feel differently if it were income tested?
Oh, yes. I mean, that's essentially what the income-driven repayment program does. It's income tested, meaning you get to pay reduced payments if your income is sufficiently low relative to how much you've borrowed. But it's also has the added characteristic of measuring income over a long period of time, because we know that when people graduate, maybe their first job isn't one that's maybe in their field, or they start out as a barista or something, right? That's the classic New York Times example of a struggling student borrower. But then, if you follow those people over the years, they end up doing just fine. And so it does take sometimes a couple years for someone to kind of get a foothold in their profession. And so I think it makes sense to say, okay, these loans aren't affordable to you this year or maybe even next year, but let's see what happens over the course of time. And if it ends up that your degree pays, then I think it's reasonable for you to pay back your loans. If it turns out that it doesn't, then let's get you off the hook somehow.
Well, thanks so much to Beth Akers for joining us in the beautiful Sleep Number virtual studio. Beth Akers' book is called Making College Pay. An Economist Explains How to Make a Smart Bet on Higher Education. This is Jill on Money, and we will be right back. You're back. It's Jill on Money. And before we head out for the day, let's do one more email. And remember, if you've got an email question, all you need to do is send us a note. You can just go onto the website, jillonmoney.com, and click on the contact button. Very easy to do. That's what Jim did. He says, I'm interested to know what you think about investment vehicles to use after maxing out the 401k. My wife and I are currently 40. We've got $1 million in 401k and Roth IRA accounts. That's great. We also have about $350,000 in deferred compensation through my job. My income is about $225,000 a year, and my wife is currently at home taking care of our kids and volunteering. I max out with contributions to my 401k each year, and we now make too much to use a Roth IRA. We have $80,000 in 529 plans for our kids who are ages 9 and 12. And they regularly contribute about $8,000 or $9,000 per year into those accounts. We have about $65,000 in our rainy day fund, $25,000 in a brokerage account. Lots of info just to get to the question of, I normally have another $500 to $1,000 per month to invest. Would you recommend adding to our brokerage account or another vehicle? Thanks so much. I'm a relatively new listener and I love the podcast so far. Okay, so he says we have 80,000 and 529 plans for their kids. I read it as 80 total for 9 and 12. Let's just say that I think if you have 80 total for those 529 plans, you're going to have to put more money in. If it's 80 each, then you could do a backdoor Roth, which presuming you didn't mention any other traditional IRA accounts, maybe you would do that. That would be fine. But I have a feeling, I don't know why I just read it as like this extra money. I just popped out to me that maybe this should be 529 money. So I have a feeling you're going to want that to be that little extra push will help you out, putting some extra money away for each of those kids in your 529 plans. Okay, that's it. That's the show. Thanks so much. Thank you so much for listening. Don't forget to do something nice for someone else today. And remember, our music is composed by Joel Goodman. Mark Talercio is our executive producer. And we just want to let you know that we are here for you and we very much appreciate you listening. We'll talk to you next week.